Following a challenging year in 2022, marked by a surge in interest rates, the stock market has discovered a sense of relief in 2023. Investors are celebrating the impressive performance of the Nasdaq Composite Index, which has risen by a substantial 31%. This upward trajectory bodes particularly well for the fintech sector. Notably, the stock of SOFI Technologies has surpassed even this impressive performance, experiencing a remarkable 88% surge within this year. This achievement remains noteworthy despite a subsequent 16% decline since the beginning of August. Initially, SOFI stock experienced a surge following positive earnings, followed by a retreat to lower levels, continuing its downward trend. However, it's important to note that this shift in price doesn't necessarily indicate an overall negative change in the larger narrative. While uncertainties about short-term performance persist, the enduring potential for growth within this financial disruptor supports the likelihood of future price increases. To gain a deeper understanding, let's delve into the reasons why considering SOFI stock at its current levels could be a prudent choice. After reporting Q2 earnings on July 31st, SOFI Technologies witnessed a 20% surge in its stock value, only to relinquish a significant portion of those gains later. The company achieved a notable Q2 record revenue of $498 million, marking a substantial 37% increase year over year. Notably, its adjusted EBITDA also soared by an impressive 248%, reaching $77 million. The surge in the company's shares following the robust Q2 results was accompanied by a net loss of $47.5 million, a significant improvement from the previous year. Improved guidance and the potential for achieving GAAP profitability in Q4 generated excitement among investors, especially in light of the company's historical losses. Even the CEO emphasized the record adjusted EBITDA of $77 million and the strong margins achieved by the company. Additionally, the addition of over 584,000 new members brought the total member count to 6.2 million. Signifying a substantial 44% increase year over year. However, the decline in stock price raises questions about the company's valuation, particularly in comparison to traditional banks. The decision not to forgive student loans and the resumption of loan payments in October resulted in a noteworthy 37% increase in the company's shares. The company's foundation is rooted in providing affordable education, with student loan refinancing serving as a core product. As loan payments resume, consumers might turn to student loan refinanciers for relief, especially considering the financial challenges they may be facing. This improvement suggests the potential for net profits in the near future. While the company is riding the wave of positive momentum in 2023, as reflected in its stock performance, potential investors should carefully evaluate their choices. While the digital bank benefits from student loan refinancing, challenges related to loan repayment could pose financial risks. Notably, the current price-to-sales ratio of 4.3 times is significantly higher than earlier in the year, making valuation a critical aspect of assessment. Management expresses confidence in achieving net profitability by Q4 2023. Despite an initial surge, the stock has experienced an 8% drop, potentially due to concerns about overvaluation. At present, shares are trading at less than 5 times their trailing 12-month sales, a reasonable figure considering the trajectory of growth and the imminent attainment of profitability. This suggests substantial potential for future growth. In comparison, Visa is a company that has been consistently generating growth. As a California-based payment network processor with a global presence, Visa collaborates with over 100 million merchants worldwide. The company's revenue for the recent quarter reached $8.1 billion, marking an impressive 11.7% year-over-year increase. With inflation receding, consumer spending is on the rise, including in the realm of travel, which is contributing to increased transaction amounts and payment volumes. Visa's processed transactions also demonstrated a 10% year-over-year increase. The company's strong financial performance is a testament to its successful strategies, and it has outperformed the market returns over the past 5 years. Visa's appeal to companies lies in its robust brand name, and the company is actively pursuing new deals to enhance its top and bottom lines. As Visa expands its payment network and captures greater market share, the future outlook appears optimistic. While Visa's stock is approaching its 52-week high of $245, the potential for the company to reach new heights remains promising. With a year-to-date increase of 16% and anticipated earnings growth, the stock's upward trajectory is likely to continue. Moreover, Visa offers a quarterly dividend of 45 cents, yielding 0.75%. With Visa's solid business model and potential to thrive in volatile market conditions, it stands as an attractive stock for long-term investment. Similarly, NVIDIA is generating substantial buzz ahead of its quarterly earnings report, scheduled for release shortly. My long-standing admiration for NVIDIA extends even before the company made significant strides in the field of artificial intelligence. Originally known as a leading gaming GPU manufacturer, NVIDIA has evolved into a trailblazer in the realm of AI. It's important to acknowledge that NVIDIA's ascent is merely in its initial stages, and there's much more to come. If you've missed the opportunity to invest in NVDA stock previously, now presents an opportune time to consider doing so. As the company prepares to unveil its earnings, expectations are high for a surge in the stock's value. NVIDIA is positioned as one of the prime candidates for generating substantial returns and potentially making investors millionaires. NVIDIA has projected revenue of $11 billion for this quarter, and its second quarter performance has already surprised the market positively. While some express concerns that the company might be overestimating its projections, I believe that a company with NVIDIA's track record and capabilities is unlikely to do so. In fact, the revenue might even surpass the projected $11 billion mark, further influencing the overall market. NVIDIA's current dominance in the AI race is undeniable, and its recent achievement of a new 52-week high at $481 underscores its upward momentum. With a year-to-date increase of 220%, NVIDIA's growth trajectory remains promising. Therefore, investing in and holding onto NVDA stock for long-term gains is a prudent strategy. Turning attention to new holdings, it's important to recognize that despite its stock price of $7.23 per share, this Brazil-based digital bank shouldn't be underestimated in terms of its size and impact. With a market capitalization of approximately $35 billion, the parent company of Nubank has established a significant presence in its home country. It's worth noting that around 80 million out of Nubank's 84 million customers are based in Brazil, illustrating that nearly 49% of the adult population in Brazil holds an account with Nubank. This impressive growth caught the attention of Berkshire Hathaway, which made an early investment in the company, highlighting its endorsement from Warren Buffett. Moreover, recognizing that growth might slow down in Brazil, Nubank has expanded its operations into Mexico and Colombia. In these countries, customer counts have risen by 33% and 133%, respectively, compared to the previous year, surpassing the 27% increase observed in Brazil. Although the customer base in these countries totals about 4.3 million, their growth rates indicate that Nubank's business model is viable in other Latin American regions as well. The success of Nubank is also reflected in its improving financial performance. The company achieved $3.5 billion in revenue during the first half of 2023, marking an impressive 71% increase compared to the same period in 2022. Notably, the digital bank also achieved a net income of $367 million, a substantial improvement from the $75 million loss in the previous year, thanks in part to controlled growth in operating expenses. Despite these achievements, the stock performance of new holdings hasn't aligned with the company's success. Despite a surge in value this year, new holdings stock remains below its IPO price of $9 per share from late 2021. Nevertheless, with a price-to-sales ratio of 8 and a robust growth rate, the ongoing performance should eventually vindicate Berkshire Hathaway's initial optimism regarding this fintech stock. For more videos, press the like button and subscribe. With that being said, I wish you happy investing.